Okay, so now we've seen evidence that the concentration is rising. We've seen evidence that the entry of new firms and the exit of old firms and the turnover within is declining, indicating things are kind of getting frozen in place and people are locking in their positions. And we've seen evidence that the Lerner index markups are increasing, although it may be a very small increase or it could be a very large increase depending on cost. And again, this goes back to that's the whole challenge of the Lerner index is you don't have great access to the data you need to estimate it well. However, another problem with the Lerner index is that it can be the case that firms charge a high markup, but there's actually no problem with competition. And the pharmaceutical industry is one example of this. In a healthy pharmaceutical industry where new drugs come on to the market all the time and people are constantly innovating and developing new treatments, you would expect to see lots of markups. And that's because that's an industry where there's a very high fixed cost, and to cover your average cost, you need to basically charge higher than marginal cost. Okay, so it could be that all firms are earning practically zero profits. They're charging prices barely high enough to cover their operating expenses on average over the long run, but they seem to have a high markup. On the other hand, it could also be the case that the concentration is going up, markups are going up, and that's because there's market power and firms are making a lot more profit, and it's bad for consumers. Okay, and one place to look is to see what's happening to the profits of firms. Okay, so if we're in that first case, we should see that firms are not making a lot more profit than they used to be. And if we're in the second case, then we should basically see that firms are getting a lot more profitable. Okay, and again, this is another area where the measurement is tricky and people dispute exactly how much firm profits are rising. So let's look at a couple figures. So you can measure this as a rate, like the return on capital, or as just the gross profits relative to some benchmark. So what we've got here is from this Economist article. And on the left, we have U.S. domestic corporate profits as a percent of GDP before and after tax. And you can see here that there are different ways to measure this that give you very different answers, right? So the free cash flow measure, the light blue line, gives this large increase in the profit rate as a share of GDP. The dark blue line, which is just profits after tax, has gone up a little bit, but it's like not that different from the peaks in the 60s. You might say, well, we're still getting close to all-time highs, but I don't know. We're not like in unprecedented levels or anything. We don't seem to have moved around that much outside of historical norms. Another way you can look at this is companies' return on capital. So what they invest and then what do they earn on that. And there's some evidence, that has actually gone up quite a bit. And again, though, people dispute what's this all mean. Another thing that changed over this time period is globalization. And so there were just a lot bigger markets to sell into. And so firms that were able to access those markets made a lot more profit. That doesn't necessarily mean that it's bad for consumers. But there you go. What else do we have? I think we have, just two other measures that show sort of a similar thing. So the guys who came up with the initial attention-grabbing Lerner index, in their paper, they had this figure on the left too, which is the average profit rate weighted by sales. And again, you see kind of some similar findings as what we found over here, which is that there's been this increase since the 2000s, pretty dramatic. But again, it's not like it's not so much higher than it was in the, a couple decades ago. So in this case, in the 70s, which would be sort of like, they're basically comparing, that's kind of zooming in on this area. This is profits as a share of GDP. This is the profit rate. Okay. Lastly, I think this is largely a similar data, but it's just another way of sort of looking at it kind of in a nice way. This is corporate profits relative to in the U.S. relative to GDP after making various adjustments. Okay. And this is closer to that second estimate we saw where there's been some kind of break with the historical averages. Okay, so we used to be kind of bouncing around in this area and we seem to have bounced out of it a little bit.